The short-term advantage that these guys have is that Solly Lou plays hardball, and with COVID came, the situation where a lot of retailers were in trouble, and he used that to hammer down rents across the board.
Yeah, controversially, in
some
ways.
I think it's fine and it's good and it's exactly what we need, because what are the landlords of this world, and I'm a landlord, but the landlords of our country, we're putting up the price of everything. Because it always goes into the price of what you're buying at the very end. Is if you've got high rents, high property prices, the price of everything goes up. So it's a good thing that we have actors that will push down the price of rents, and that's going to be great for the business short term. Now, eventually, if they're getting an unfair advantage over landlords and there's a lot of demand, eventually those rents will have to go back up anyway. But in the short term, it could be a good couple of years if they've used this crisis, never waste a good crisis, to push down their cost base. I think it puts Premier in a pretty good position. On top of that, I think it has to be said that based on the numbers they've given now, if you're willing to believe that profit is sustainable, then I think it's on about maybe 18 times earnings, something like that. But that ignores the fact that they've got a lot of interesting stuff on their balance sheet, including, I think, $1 billion worth of shares in Breville. So I think you could put together a sum of the parts argument that says that this is a pretty good investment now. It's obviously not exciting enough for me, but I have to say, if I was just looking to have some long-term retail exposure and buy and hold, then this would be at the top of my list.
But you're not buying today?
No, I have no particular affinity for retail. I can barely convince myself to hold on when I find something really exciting in retail. So no, not for me.
You're not buying either?
No.
Okay.
I'm not chasing it.
No, but would you hold it if you're already a shareholder because you think that the trajectory, at least in the medium term?
Yeah, there would, at this point in time, there would not necessarily be a reason to sell here. Yeah. And you're getting something along 3% yield in dividends. Although I would argue there would be probably retailers out there with less risk, I think. But yes, if you're a shareholder and you're on a good ticket, there's no reason to immediately sell out here.
Okay, so that is the stock of the day, Premier. Let's get on to the companies that have been brought to us by you, putting it that way. Philip has written in about CSR. So we all know what's happening in the building space, the home builders, the stimulus, the housing market is just
pent-up demand.
Crazy. Yeah, well, we don't have migrants coming in, so that's one thing to take into consideration. And of course, inflation as well. Does CSR have the ability to pass on its higher costs to its users, its clients?
That's probably a question for an expert in the industry, which I'm not. But I think that most of these businesses do eventually have that ability to pass it on. That's what's going to happen. Sometimes I think the reason that businesses in general worry about inflation is if you do have sudden inflation, then you can get caught with shortages or not being able to fulfill demand, or if you've got in a position where you've already done a fixed price contract and suddenly your costs go up, you can blow up. But I assume they'd be managing that pretty carefully. For me, I think that longer term share price chart pretty much tells the story that is front of mind for me when I look at this kind of business. I just can't I want to invest in businesses where I can clearly say the long term is my friend. So if I've made a little mistake and I've paid too high a price when I bought in, if I'm confident that the long term is my friend and I continue to have confidence in the business, then for those kind of businesses, you can kind of just hold your way out of trouble. And if the long term is on your side and this is going up and to the right over the very long term, then even if you overpay a little bit at the beginning, you can still end up having a good investment. As long as the business keeps firing. I don't like to invest in up and down businesses that are always cyclical. They have the good times followed by the bad times. That is not something that I invest in. And if you look at the actual profits as well, they've been up and down as well. And if anything, I would say the 5-year trajectory of the EBIT, so this tries to exclude some of the abnormal factors, that's been in fact trading down. So for me, I would avoid it, even though there's a lot of demand and it's a bit of a hot space right now.
Everything that Claude just said, with a little bit of a difference in opinion, just a little bit. I always feel the need that I have to repeat that this company is responsible for one of the most disastrous acquisitions we've seen in corporate Australian history. It's called Viridian Glass, and ultimately I think it's now worth 0 on the balance sheet, and they paid a lot of money for it with a lot of promise. This is not quality. This is really, and you can tell by just looking at the numbers from the past 2 decades or so. This company is one of those very old-fashioned Australian companies. I mean, I believe that the S stands for sugar originally, but that's really a long time ago. Anyway, the only reason why you buy CSR is for the cycle, and we now have a completely a pent-up demand, accelerated in the local housing sector. That is probably going to last a little longer. The share price is not excessively priced for that up cycle, so that's the only reason I think that you buy this stock and that you would own it. But again, it's one of those examples. You date them, you don't marry them. You do not stay on board for too long, and history shows that. But Claude has already speculated on that one. It will come down to one stage. Probably here is more upside because the cycle has longer to go, and that's why. But don't stay on board for too long.
Well, it's at $6 today. Would you buy today?
You can buy today for the upside that will come if this cycle lasts for at least the next 6 months, which I believe it will. But again, take your profits in time.
Okay, that is for you, Philip, but not a overwhelmingly ringing endorsement. I don't think that was the strongest buy I've ever had coming from Rudi, but it is a buy. Home Consortium is HMC, and that's for Luke. So this is a company, from everything I read, that's going through a transition. So
it's actually very interesting how it started.
Yeah.
This is the failed experiment from Woolworths to try to compete with Wesfarmers in the home renovation space, basically. And these guys are probably amongst the most entrepreneurial in that sector. I mean, they bought those assets from Woolworths, and they thought, hey, we can do something interesting with that. And
now they're spinning off these REITs.
And now they're developing all kinds of other portfolios. Long story short, I wouldn't chase it here. I don't think it's cheaply priced here. It's obviously priced on a lot of exciting stuff coming out of this. I would, if you're interested in joining this one, I would wait for a pullback, which eventually will happen. Okay? But this is pricing in a lot of upside and of course a lot of excitement because they are creating new portfolios, spinning them off, giving them to investors, etc., etc. It's all a very great story in itself, but you probably want to join them in a lower share price, I would say.
I completely agree. I think this is trading on a forecast FY21 dividend yield of 2.2%. And if I'm going to be in this game, I definitely want more than that, like maybe even double that, basically. So for me, it's just too high based on the best metric, in my view, to value this kind of thing is dividend, and I feel like there must be a lot. I mean, they're doing a lot of things. They're spinning off new stuff. They're going to raise another $1 billion of equity for a new REIT kind of thing that they're doing. So like, there's reason to believe in growth, but I wouldn't want to count on it. I don't want to pay for like inorganic growth. So these have to put together deals and stuff, and you have to have continual deal flow and all that kind of thing. It's not like they've just got some sweet product and everyone's knocking on their door saying, hey, I want to buy it. It's not like that. So I don't want to pay up for that growth in the future, basically.
Okay, so there's a quality to the growth that you need to be buying for or paying for. Okay, Home Consortium, moving quite quickly through this list. Accent Group, AX1 for Sam. So this is the company that sells a lot of shoes. It just bought that glue store. It's in that sort of competitive space with Universal stores because they do more than just sell shoes.
Oh, and also Accent has been around for quite a... I actually forgot what... They used to have a different name, but I believe, but a long time ago,
RCG, I think it was that.
Yeah,
okay,
exactly.
all right. Yeah, actually I do remember that as well. Okay, so what's the story with Accent Group? You could talk about it's in the retail space, again, goes to that consumer spend.
Like them a lot.
Really?
They're very entrepreneurial. They have historically, and the best way, I believe, the advantage you have when companies pay dividends is you can get blinded by the bottom line, which can be impacted by a lot of factors, but the dividend doesn't lie. The dividend is cash they pay out. The dividend is over time, basically in a steady uptrend. Apart from, I mean, here and there they did have a stumble because they are retailers, but in general terms, the dividend goes in a steady uptrend. That's one major reason to own this company, because as long as the dividend keeps on going up, the share price volatility will kick in an uptrend as well. This is a very highly regarded team of retailers, basically in Australia. Footwear, shoe wear. I've been to there and measure my foot and everything, and you get the right thing around your foot. It works, yeah, and
That's why you've got a spring in your step.
Exactly, all right. And yes, sometimes you pay a little bit of a premium, but if you know that you're not doing too much damage to your back while walking around, that's worth paying for. Anyway, long story short, I would be comfortable to put this one bottom drawer in your portfolio, steady dividends. Always, of course, always volatility because it's a retailer and it goes up and down with the economic cycle. But I think this probably is less volatile, less risky than Premier investments, which sells you suits and
jeans and everything.
Yes, I think shoes are more steady and reliable.
Favorable rental agreements, I suppose, could work in favor of Accent Group as well.
Yeah, I didn't follow how much they capitalized on that, so that's a little bit of an unknown, but that's a good point. There could be upside down. Look, I assume there would be anyway, because I think just generally there's a bit of weakness in that market, so they should be doing well out of that.
And they want to roll out more stores of this glue acquisition.
Yes, so I think that probably by now we can say that their model that's a bit of trying to get organic growth but also like tacking on new stores, I think by now we can probably say, we can trust these guys to do this. I've been following this company in the side of my eye for many years now.
You know the name, RCG.
This is what I had to look up. I actually bought this is a typical me investing in retail experience. I bought this stock at 60 cents in 2013. And then changed my mind and sold it at 58 cents. So
I love your honesty, Claude.
Yes.
So that's the problem. Like, if I'd held that, I'd have been onto like a nice multi-year multi-bag at exactly what I'm looking for, right? That was exactly what I was looking for. But the problem is, I think my personality is skewed towards wanting to see like recurring revenue and feeling super safe in that, and just knowing that as long as the business delivers, and because I'm looking at the business, and as long as I trust the business to keep on going up or whatever, then I'll just hold on. And I just always get worried with retailers. Who knows what spooked me? It was like probably there's some weak retail numbers, some retail softness or whatever, and suddenly I'm like, this seems like a bad idea, and sell. And of course that's in the end, that's the noise, and the real signal is that this business model seems to be working. I do agree with Rudi. I think actually shoe retailing is something that is a bit more value added than some other retailing, and it's definitely worth spending on good shoes as well. Like it's like shoes, dentists, accountants, lawyers. You want to spend money on it. You don't pinch penny.
I always buy my kids good shoes. I mean, a little bit less for myself, but
anyway, you haven't failed. You have learned the lesson.
So did you? Is there a lesson to be learned in terms of buy, hold, sell for this one now?
I think the lesson to be learned is definitely, I agree with Rudi, this is one to pop on your watch list. It seems to have proved its business model out now. I don't know if they can continue doing this. When you have roll-up style business models, that doesn't always work forever. But then again, with retail, scale is a bit of an advantage, genuinely. So that can help as well, and it can work better in that kind of environment. So definitely one to put on your watch list. I wouldn't be against buying it. I think part of the lesson I've learned over the years is generally I just don't try too hard with retail, because I just know You're going to mess it up.
I
don't do the good, strong multi-year holds with retail. So I just try and pick it for shorter term stuff. But I think it's a good company. So I guess it'd be sort of a hold for me.
Okay. I've had a few emails in that we've got to define this definition of hold a little bit further. I'll put some thought into that one. If you're watching, you know who you are.
It means Claude likes it, but he doesn't want to put it in the portfolio.
And I don't want to buy it myself.
And that's it. Stick with it. If you wouldn't buy it today, that's the rule that I go by in terms of a buy. Then we don't call it a buy. All right, Blackmores, BKL. This is for Jeremy. Jeremy, everybody also remember this is information only. It's not taking into account your personal circumstances. So that is consider yourself warned. Blackmores for Jeremy. Okay. So I take Blackmores vitamins sometimes when they're on sale. I buy them 50% off. I mean, they're 50% off a lot of the time. What's that telling me, Rudi?
There's a German brand has come into Australia, and they're very cheap as well. Let me check. The computer says no.
Okay.
I've followed Blackmores for quite a while. I used to be quite favorable.
You did.
Towards them when everything was going right, and they were going into Asia and into China, and they were selling a lot of vitamins. But I've also learned from the years of observing them where their weakness lies, and their weakness is in the marketing department. And just as I've noticed, there's a German brand now coming into Australia and offering their products at much lower value. And I'm buying the German brand. I mean, why am I paying double the price for vitamin C? I don't know, right? I won't. And that's the weakness of that sector. I mean, the weakness of that sector is every time the competition kicks in with marketing, they are forced to ramp up their marketing as well, and there goes your margin, there goes your profit. So essentially, when you own them, you're at the mercy of the competitive forces in that market, and to me that's too weak. I'm looking for the moat which isn't there. For me, that's too weak a proposition, and at the moment, at this particular point in time, there are so many question marks about what's happening with Blackmores, and I mean, internally it must be a complete struggle to get that business back to even close to where it was. And I know there's potential, there's all Asian countries, but it doesn't take away the fact that they are very much at the mercy of the competitive forces.
They can, invest in IT, they can improve their supply chains. Are there levers that Blackmores can pull to bring them back to the glory days?
So the glory days were driven by like the huge Daigou trade that was happening, and their peak profits like multiples bigger than what they are currently. And if they got back to those, but I guess those sales, because their revenue's gone up since then, right? So those sales were obviously like super high margin. They're having people take them off the stores in Australia and send them back to China mostly. But also the Chinese government then put in new rules a couple of years ago that basically made the small style Daigou that was just maybe a student or someone having a nice little side hustle, that was like a really profitable thing for Blackmores and A2 Milk and Bellamy's. And they took, the Chinese government, as I understand it, effectively killed that business model largely. So there are still, I guess, what you call corporate Daigous, and I'm not quite sure the nuances of how that works. But what I do know is those corporate Daigous are bigger and they've got bargaining power that the little guy doing a side hustle did not have. So if you're Blackmores, the idea of having tons of people coming to buy as part of their side hustle at full price, in fact, showing their customer a photo of the full price Blackmores is like the advertisement. This is the real deal. It's not fake. I'm showing you the shop that I'm getting it from, and it's premium priced, and that makes the buyer think, yeah, I'm getting the really good Australian stuff. I don't think that's coming back. But if you think that's coming back, then sure, Blackmores is a buy, definitely, because its profits were more than double, I believe, what they are currently now in the glory days of that trade. But yeah, no, for me, I actually think it's not coming back, and so I don't think Blackmores is a terrible option right now, but I see no reason to own it, basically. Okay, so you would not, you're avoiding this one, and how about you, Rudi? Was that a sell? Yeah, or avoid. But I mean, what's in a word? It's not buy. Okay. Let me give my little trade idea. Like, I'm not going to take this trade, but I think there's potentially a trade. Like, surely this does pick up a bit once we do reopen to international
stage it might,
students, and which we're already. That might be one of the first things we open to is having more students come in from China again. Like, I don't know, touch wood, we used to have lots. And that might pick it up, I don't know. I'll tell you why at one stage the share price will be higher, because you simply get the 12-month comparison, which at some stage becomes so low that you will make at least the impression of we're getting it right. Yeah? It doesn't mean that you are. Yeah. I think there might be a trade in it, to be honest. But you're not going to take that trade, as you just said. I can't promise I'm going to not take that trade if I like, but I don't think I will. Nobody's going to know, Claude. Just play along for this purpose. I'm not going to take the trade in it. Yeah, this is, and Rudi, so if you held Blackmores, would you sell it? I mean, because it's not well, the risk is not gone. The mistake that people always make is they think, well, the share price used to be more than $200. Now it's, from memory, it's something along the $70 line. They think, oh, obviously now it's a lower risk proposition. It actually isn't. Right? The risk doesn't necessarily disappear by default because the share price is now a lot lower. The share price now is a lot lower because the risks have increased basically, and the profits have disappeared. So this can still disappoint. And history shows you that when companies are in trouble, I mean, A2 Milk is in trouble, Blackmores has been in trouble. It can take a while before they turn around. In the meantime, you could make more money and safer money elsewhere. Got it. NRW Holdings for Paul. This is the mining services space, energy, metals. It's got an infrastructure arm. I feel like I know what you're going to say. Market doesn't want to go there, but everyone who covers this stock thinks it's exceptionally cheaply priced. But the market has been incredibly harsh on them after they
released their market update. I think it was in February. Well, you can see there, the share price was a lot higher in February, and after that it just fell like a rock. The problem with these type of companies, and we've seen that, you see it time and time again, they are so dependent on their customers not paying out dividends, but actually opening up new mines and new railroads and etc. And if one of those customers gets unhappy, then no payment, or they take them to court, or the business can go bankrupt, and that's what often happens with. I think, given the fact that the business is now so cheaply priced, and the fact that the commodity sector is going through a boom time, I think that you can take a punt here and just take the view that at some point contracts will roll in, and management will tell the market, listen guys, our margins are no longer falling, and then that share price could potentially can absolutely shoot the lights out.
Well, that's a buy from you. Would you be buying NRW Holdings? I know it's not an area of the market that you like investing in, Claude, but if you look at price and you look at potential with this commodity boom on and infrastructure spend, that pipeline is strong.
Yeah. So look, this is probably one of the only mining services stocks that I even bother to keep up with, and this is actually one I did in my early days before I realized never to buy mining services stocks. I actually own shares in this one as well. So if it repeats it, even its current dividend, half-year dividend, I think about 4 cents. So if it even just repeats that, it's on a 5.1% yield. Now this business has been around for ages, so I think we can sort of say, look, it's going to keep on keeping on for another 10 years and stuff. So it's definitely...
Ooh, be careful.
You reckon? Well, I think it is.
Remember Forge.
Yeah, Forge was a disaster, but these are the kind of things you got to look for. So Forge blew up, but what was happening is they were incentivized to grow earnings per share, and they did that by taking on heaps of debt and buying short-term earnings per share, which triggered all of the bonus payments for executives. But then the earnings per share that they'd bought evaporated, and they'd taken on debt to buy this, because that's how you increase earnings per share. Don't increase the shares, use debt, buy another business. So that's how they blow up. So
RCR Tomlinson was more than 100 years old when they blew up.
Yeah. Didn't these guys take advantage of that? But yeah, anyway,
yes.
I think these guys have been one of the better run mining services business over the last 10 years. And I don't know if we've got a 10-year graph, but the thing is that actually in 10 years, it's that was $1.30 in 2013, this share price, and it's $1.50 now. So I think, yes, if you bought it when it was right in the doldrums, then you've done that extremely well. And you can probably just buy and hold, and you're getting paid. If you bought it at 20 cents, you're basically getting 25% of your outlay as a dividend every half year. So you're laughing, and I know people that have done that, and they're just going to hold on, and I think they'll do fine. Is it low enough now to be diving in? Not in my view.
5% yield.
Yeah, I think you actually, probably conversely, you want to buy this when they've sort of just had to cut their dividend because they're freaking out and work's dried up, and then it's kind of looks bad then, but you're betting on the rebound and that things get better. So it's not low enough now for me to say, oh, it's a contrarian play. Having said that, I'm kind of glad the person wrote in, because I think if they do want to invest in mining services stocks, these better quality ones, there's a few others as well that are decent quality. I think Mineral Resources is a good one. They're the ones you probably want to keep on your watch list and try and buy. But no, for me, I just don't invest in this sector because it's just
If my memory serves me correctly, and obviously this chart doesn't go far enough, I think in 2007 or so, this was $9, I think.
Yeah,
oh, really?
I think it's possible.
Yeah, my computer's died. I can't look that up. And I don't have that in this Rolodex that is my brain at this stage of the game. All right, we're halfway through. Let's get you across the first 5 stocks. And stock of the day is Premier Investments. It's a no from both of my guests here. Rudi's just worried that the music will stop in terms of retail sales. And Claude thinks that it's had a good couple of years, played the COVID cards right, but he's just not really interested in investing in this retail stock. Okay, so let's get to the companies that you've written in about. Philip for CSR. It's an avoid for Claude. It's just too cyclical. It is a buy for Rudi, but there's a caveat. It's got to be on just sort of a 6-month horizon to cash in on the cycle that we're going through right now. He does not think that it's a quality company. So you make your judgment based on those comments. A home consortium for Luke. The yield is too low to be in here for Claude. If you're being in this space, this property space, you want to be getting paid a lot better for it. And that is sort of what Rudi thinks as well. It's not cheap. if you're going to get in, you'd wait for some sort of a pullback. So that's not a ringing endorsement, Luke. Accent Group, AX1, it's a buy from Rudi. He actually thinks as far as retailers go, it's pretty entrepreneurial. He also likes treating his feet well, and he says that the dividend does not lie, and it's in an uptrend, so you could buy this, put it in a bottom drawer. Look, Claude doesn't dislike this one. It's on a watch list. He does trust the company to execute, but it's just a hold for him. Again, he's not really big on getting into the retailers. They're still cyclical. Now, Blackmores is an avoid for Claude. He believes that there's been a fundamental shift, particularly for that higher margin Daigou channel into China, and it's a sell for Rudi. I'm calling it a sell because you're at the mercy of competitive forces always. He says his computer says no. Now, Claude was talking about a potential trade for Blackmores, but that's just not what today's conversation is about. Now, when it comes to NRW Holdings for Paul, it's one of the better run mining services companies in Claude's view. It's just not cheap enough for him to buy it. It does have a pretty good yield. It's a hold. It's a buy, though, for Rudi. It's exceptionally cheaply priced, he thinks. And so if you believe that the CapEx spending is going to come through, then this would be a buy. So you know about our portfolio. If you don't, I'm about to tell you about it. We've been tracking these companies since July 1st last year, and this is thanks to our partner, NAB Trade. So we have a 1 week return of about 0.4%, 1 month, close to 9.5%, and in the financial year to date, up just around 40%. So not too bad. Now the rule is if both of the guests give a company on the day a thumbs up or a buy, it has to be a buy, then that company gets put in. And if they at a later date are discussed and it's not a buy, then they get taken out. Sad days for Pro Medicus and potentially our portfolio as well, where we started the conversation. So some of the companies that we've been putting in lately, well, I know yesterday we put in a couple. We put in Unity Group. You guys know Unity Group?
Yeah.
Good call for the portfolio?
Yeah, I reckon it's an interesting one. It's a bit of a fundy favourite right now, so it could be a little bit too optimistic,
Yes.
but we'll see. Yeah. No, it's a good business.
Very high expectations.
Yeah, the other company that we put in has just slipped my mind right now, but we put 2 in yesterday. None have gone in today, as you well know.
Yet.
You never know. A2 Milk is another one that we put in recently. Look, you can check out everything that's in the portfolio. Go to ausbiz.co/portfolio. And just a bit of a promo to get you across. The latest company to hit the boards are Argenica Therapeutics, following a $7 million raise. It's trading quite well. It's come online, and we'll be speaking with the CEO, Dr. Liz Dallimore, a little bit later on. So it's just past 1 p.m. actually, so don't switch off if you're watching now. You can get all the details from the horse's mouth for this newly listed company here in Australia.
Good to see more female CEOs.
Yeah, absolutely. I'm with you, Rudi. Females in general, anyways.
I think the healthcare sector will probably be the sector to do it.
I heard on Twitter not long ago a fund manager disparaging female CEOs. I thought it was disgraceful. But one counterpoint is look at Alcidion. That's just been, I own shares in that. Kate, the CEO of that's done a great job. She took over when it was 5 cents, 40 cents now.
Yeah. Well, it's not necessarily gender specific, but I take your point.
We can also say Blackmores was one much better when it was under a female CEO.
Yeah, and then I spared a thought for the new CEO of AMP. We talk about that pink cliff, I think it's called, that oftentimes females are brought in when a company's at the precipice.
Being the CEO of AMP now is a punishment.
Yeah. Anyways, I'm not going to weigh in. Editorially sound. You brought up medical and health and devices. Let's talk about medical developments. This is for Sean. MVP is the ticker code. My kids are obsessed with Bondi Rescue, so I know what the green whistle is. They are very curious as to what the green whistle is and how it makes you feel.
Oh, I can tell you a story about my son. My son was a little guy and he needed one. And he actually asked for another one. He liked it that much.
Yeah, I don't blame him. Okay, so as an investment, though, what do you think of medical developments? It was hit hard, through COVID.
Yes.
Well, so I've got such a long... I love this. This is a great one to follow. I've been following this since I owned it in 2013 when it was completely under the radar. Stock price $1. Typical Claude learning to invest style. Didn't hold on long enough. which is always the failing for me as a beginner investor anyway. So I didn't make a profit as it rise to its current price, which is about 4 times that. However, this is probably the one that I find most interesting and exciting to talk about today. And in fact, right after this show, I've got an article on this sitting in draft, so I'm going to go and publish that.
Oh, good.
And what's more, I bought shares not that long ago, and so I should disclose that. And I'm only bought a tiny amount of shares, so I'm actually looking to accumulate more of this, right?
Can I be nosy? What price did you buy?
I'm feeling a portfolio inclusion coming up.
Oh, okay.
$4.78 was my little nibble that I did recently. And basically, I think under 5 is interesting, but let me say why.
Okay.
So this business has a few moving parts, but there's only one part that I think is interesting, which is the Penthrox green whistle one, which of course is such a great way of helping someone who's in painful trauma. Like I had it as a kid when I broke my collarbone, skiing accidents, whatever it might be. And so it's like the ambulances carry it and that kind of thing. And this drug is not an opioid drug. So even though you're not supposed to use it repeatedly because it could damage your kidney if you did, it's also a great way of helping someone without giving them opioids. And that has a lot of advantages. And that's particularly front of mind now in the US where they have a terrible opioid problem. Now, guess what? And this is the history hardly anyone knows, is that many years ago, this was a drug that was approved in the US. But for some reason I don't quite understand, but maybe because they had a competing drug, the people that owned that in the US asked for it to be taken off as an approved drug because they were worried about how the dosages they were using then could hurt the kidney. So they did, many years ago, maybe 30 years ago more, they took it off the approved lists in the US. Since then, it always remained approved in Australia, and medical developments changed the dosing thing to make it safer, basically. So they've done a lot more research. This has been used extensively for more like decades in Australia. So many people have had it, very few problems. Like every single sign indicates this is a safe and great way of helping people in distress. Now, a few years ago, we're going back to like 2013 now, medical developments invented a better way of manufacturing it, which improved the margins after they did that. And so in 2013, from Penthrox sales in Australia, they made an EBIT of 3 million. Now, ever since then, their profits not looked so good as they've looked to try and expand overseas and even move towards getting reapproval in the USA. So their actual profits since then haven't been so good. But I say, in my mind, I look back at that historical result and say, well, this is the kind of profit they could get out of selling this in Australia way back when. So if they do successfully expand overseas to Europe and USA, they could easily get 10 times that profit in my view, and maybe even more if they have benefits of scales just from this Penthrox business. Well, that would take you to about 30 million versus a current market cap of 330 today, which is PE 11, which would obviously be way too low for a growing medical devices company that is, so basically that's my thesis, put simply, and that's why I like it at current prices and I'd consider buying more.
Okay.
And I probably will.
It's a buy.
Well, let's go to the most important. The computer says yes.
Computer says yes. Okay. And this is because you agree with that thesis, that it's got potential in a
yes,
bigger market.
Yes. I think there's 2 elements which I will briefly outline because all the footwork has been done by Claude. One of them is, I think this, if you look at the share price and the history of the profits, it shows you that having a very interesting product in itself is not enough to make a good investment. There's a lot more happening. But coming back to the core, I think the share price here is cheap enough. The market is obviously waiting for more to come. And the more to come is basically expansion into Europe and expansion in the US. These guys are working on that. I think we apart from the fact that any announcements in those regards will act as a catalyst for the share price, I think we might have to wait longer for the revenue and the bottom line because they will need to hire salespeople and set up an infrastructure and all of that at first. And then sometimes, as often happens, the rollout goes a lot slower than on paper. But anyway, if you take a positive view that these guys are basically on the verge of international expansion, exact timing unknown, then you can buy this one and just wait for things to come.
So it's a buy.
Yeah.
Okay, it's going in the portfolio for you, Sean. Okay, let's get on to number 7. GLH for Chris, saying he'd love to get the panel, especially Claude Walker, this one's for you, on a little med tech called GLH. Don't feel bad, Rudi.
Don't feel bad.
Look, I did a bit of
Rudi
research.
doesn't want to talk about it anyway.
Okay, so what do you think? Do you know it, Global Health?
Yeah, of course. I love, obviously, thanks to the questioner, they do know what I'm interested in, because this is definitely the kind of stock that I've been looking at for a long time. Once upon a time, I actually owned shares in this one as well. But I bought it 20 cents.
That's what I thought. I think we have spoken about this before.
Quite potentially, although I haven't owned shares for a long time, and I don't like the business very much. It's basically, so what's the story here? I think let's start at the present. This company is in trading halt at the moment.
It is
raising capital.
Raising capital. Again,
I think what's going to happen when it comes out of trading halt is it's going to tank. And if I own shares in this business, I would be like sitting there being like, sell. But
you can't.
Well, good luck selling, yeah. But hopefully there'll be, because now they've just gone around and they've, telling everyone how good it is, raise capital, we're going to use the capital to build a sales team, blah, 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 blah. So maybe there'll be some people that are like, think it's great, and you can sell to them, and then they can find out what it's going to be like to be a shareholder of this company.
So why has the share price risen so exponentially?
So I think, these guys have suffered from having, absolutely zero respect from the market. Like this, the founder who's been in charge of this company for a long time has presided over not a great result for shareholders over the very long term. And in more recent times, they put out like a quarterly thing saying, they have a good quarter. Yeah. There's a story they can tell there because their business itself is kind of interesting as it deals with essentially, the digitization of workflows. Mm-hmm. So they have a lot of work in, I guess, like medium-sized or clinics or smaller hospitals. They have like a Mastercare Plus thing that basically helps with the administration of the healthcare businesses, basically. It's not sort of one that is winning the top tier stuff, and as a result, whenever you're playing in the smaller organizations, the focus should be on trying to like tie up as much of those smaller organizations as possible. So it does make sense to invest in sales, and probably at the right price this is worthwhile. The problem is this company through its beginning has had global ambitions and has like consistently tried to expand overseas unsuccessfully, which is bad capital allocation. Yeah. And it's that bad capital allocation which has destroyed so much wealth for the people that have invested in the company over the years. Now, I think many years ago, the then CEO recapitalized this business at like 4 cents. Yep. So if you're buying at 4 cents, then, great. That's probably well worth it. But the problem is the history of this business that's been listed for 10 years or more is always, we want money from you guys. Yeah. How long do you have to be, like the stocks that Rudi and I love in this sector, like they make a profit. Like they're not coming back to the market constantly over a decade to say, hey, we want more money and more money. And that's what this one does. And they're literally doing that right now. They're saying, we want more money. And what's happened is you've got some really good quality health tech business on the stock exchange in ASX. Pro Medicus, Alcidion, both of which I own. There are other ones out there that are like maybe second tier but are still interesting. Volpara, Max 7, neither of which I own, but I have owned and they're decent. So those ones have been flying high recently. Like we've been just talking about Pro Medicus all-time highs. And I think that's helped drive the share price, because people are saying, oh, well, these ones are so successful, like what's the next one? And optically, I guess, based on a revenue multiple, this is cheaper, but it sort of deserves to be cheaper. Okay.
So that's a sell as soon as it's out of the halt.
Yes, definitely. I already think that it got too much attention here, to be honest.
Yeah, okay. So we can move on.
Why I disagree with Claude is I don't think it deserves anyone's attention. The one line that caught my attention when they announced the new CEO, which is also being announced, and they make a lot of fanfare about it, but any CEO that comes to this company is not a great CEO, I can tell you that one. These guys exist for 30 years. After 30 years, they make something like $6 million in annual revenue. If that's your result after 30 years, you do not deserve to be on the share market. Okay. The other thing is, which I don't understand, is they actually pay a dividend. And they're constantly loss-making, and they constantly have to come back to the market for new capital. So stay clear of it. Don't mention the name ever again, I would say.
Chris, okay.
Tell us what you really think.
I'll sweeten that somehow. Let's go to the next one.
I'll bark next time.
EBOS Group. Look, growth in earnings per share in FY21 could be acquisitive.
Completely opposite.
So give me your 60-second pitch for EBOS Group.
Solid, dependable, rising dividends and increasing market share and taking contracts away from the incumbents in Australia. Don't expect spectacular things, but as a backbone in the portfolio, yes please.
Okay, and would you buy it today at $31.05?
I would rather prefer to buy it cheaper, but if I had to, I would, if I'm really in need of allocating my capital, I would buy it today. But
you could wait for a better price.
You could wait for a better price, yes.
Especially,
and you probably should.
Yeah. Okay. So would you agree,
No,
Claude?
let's make that a hold.
Okay. Yeah. No, that's fine. I think it's clear what you're saying there.
Yeah. I'm glad that Rudi said hold, because it means I can say buy without putting it into the portfolio. Because I tweeted an old article I wrote. This is like a sleepy stock. This is a good quality sleepy stock.
Exactly.
And I do have some of those in my portfolio. And because I don't really like sleepy stocks, you have to be really good to make it one of my coveted sleepy stock positions. And EBOS is one of them. It's great. So I literally, just so that people could find it, tweeted the article I wrote about this a year ago almost, where that was the sweet point to buy, because a long-term, very early investor who had owned a lot of the shares for a really long time wanted to sell down. And it was like right in COVID and stuff, and they're trying to move a lot of stock, and that was depressing the price massively. And that was that was the answer to the question, why is this cheap now? Well, it's cheap because somebody who owns a lot of shares wants to get out, but not because they thought it was a bad business. This is a great track record of growing bit by bit. And the other thing to remember about it is there's so much I could say about it, but I'll keep it short. Look, this is a distributor, right? So they competes on margins. It can be a hard business. And generally, that's something to be wary of. However, a distribution network, for that very reason, can be a very, very good competitive moat business, because a lowish margin regulated industry, so pharmaceutical distribution, regulated industry, it's something you need scale at to work and make a profit. So how can you get new competitors against you when, in order to be profitable in the industry, you need to be at scale? So that means that this kind of business leads itself to sort of an oligopoly style situation. And then of the oligopoly players, I actually just think these guys are the best. Like, they're really good operators. They report really well. They inch themselves forward as they go, or as they grow, and they don't take too big a risk. So I really like it. And I own shares. And I haven't bought at current prices, but I haven't sold either.
Okay.
Yeah. Okay.
Go the All Blacks.
Yeah, it's a New Zealand company.
Excuse me. Got a tickle in my throat. Okay, Bravura, BVS Farage.
Yes.
Looks like they've turned out of the dip, he said. Buy, hold,
Well, that's
sell.
probably a conclusion drawn from the share price. The share price has recovered a little bit. I think it's still extremely cheap. This is usually regarded, and I remember Claude and I spoke about this, I think, a while ago. This company has pretty much had a perfect storm working against it, including customers merging and then opting for a competitor, and including the UK economy having wave after wave in COVID. I think if history is a guide, and this is a small business, by the way, but still highly regarded. And if history is a guide, they will at some stage start announcing new contracts again, expanding in the UK and elsewhere. And on that basis, I think you can add this to your portfolio.
Okay, Claude, excuse me. How about for you? Because this was put on my radar this week earlier on because of some of the wave of M&A that we've seen in the local tech space. So Hansen and Altium, I mean, is it playing in that same, is it potentially an attractive takeover target?
So I think that's probably what's driving the instant. I'm interested that Rudi maybe likes it sort of fundamentally, that's interesting. But I think that's exactly what has driven the recent rise in the share price. Like, this was not long ago trading at about $3 or under that. And I think that's probably where, to me, the valuation says, yeah, you could buy this on valuation. However, what we've seen is a lot of takeover activity in tech. And not only that, but a very vicious bidding war for mainstream, which is a business that is sort of quite adjacent to what Bravura does. It's not the same kind of business, but it's very similar. So I think people might be getting a little bit excited about takeover prospect. I definitely think that, given that it's a cheaper one, at $3, it's trading at around 20 times earnings. So you could definitely see at $3, it's a takeover target. Now at $3.82, how much of that's been arbitraged away? So that's one possibility. The other possibility is, like, people have figured out, because this is a little bit lumpy, and it missed a couple of analyst estimates, I think.
Yeah.
And either way, what that resulted to is lower future estimates,
yeah,
which ironically are then more beatable.
Yes.
So if it's just hard to predict this one, analysts overestimated it before, lowered their estimates, and now it's just having its lucky half, then it ends up beating. It's possible that the rise is because some people who are close to the industry have sort of figured out it's going to beat. So maybe that could be an explanation. Either way, even though this is a software tech business, it doesn't actually have the fundamental qualities to its business model that are actually the things that attract me mostly to tech and software. So for that reason, it's a little bit of an avoid for me, but yeah, look, under $3, I would say actually it is interesting, and perhaps I missed an opportunity there.
Okay, well, it's not under $3. And just to clarify, was that a buy from you?
Yeah.
Okay, all right, not going in the portfolio, needs both guys on board. Okay, let's get to the next one on the list, which is NextDC. This one's for Robert. We talk about NextDC a lot. The move toward data center, the move toward cloud, COVID accelerating some of those transitions. But is it still a buy?
Yes, it is. I'm shareholder, by the way. It's one of the largest holdings in my portfolio. I think the market has just been jumping at shadows. You get the whole inflation thing, bond yields moving, you name it. I mean, the mega trend is still there.
Yeah.
The demand for data is enormous. The industry is expanding their capabilities a lot. But analysts still remain convinced the demand for data is not subsiding. So at some stage, this is a sentiment thing here. The other thing which I understand is holding it back here as well is that on a relative basis, it's more expensively priced than Equinix in the US.
Yep.
But then local analysts say, yeah, but NextDC's growth profile is so much stronger, so it actually deserves to trade at a premium. I think it's only a matter of time. It's excellent management, highly regarded. Of course, they took on a lot of debt. They're not profitable, but you know what? It's actually an infrastructure play. It's not different from a Transurban. The data will come, the customers will come, and those centers will be filled.
Would you have as much patience with NextDC when you consider, Claude, that there could be a change in the trends? I've speaking, I think it was June Bailey at Tribeca, talking about the fact that we can also see a move to some of these more localized, smaller data centers than that in which NextDC is building. I mean, do you have to take into consideration, changes in technology going forward?
I mean, I guess you do, and I guess I'm more bullish on, edge computing than I think the data center stuff. However, I do agree that this is like an infrastructure play that will have long-term demand tailwinds. The only area in which I disagree with Rudi, and this has resulted in me being wrong and him being right, because I guess he's owned it and it's gone up and I never did. But the thing that has kept me out of the stock is that it seems to be like, so the free cash flow is like always super negative. So it is like, it makes sense. Okay, so for infrastructure, you need to get money or issue shares to build it out, and then later you get the long tail. So it makes sense, and I'm not saying that's a wrong strategy or anything, but I don't really like that kind of business that's capital hungry like that for so many years. So it's not one that I would personally add to my portfolio, but I actually was saying the same thing when this stock was like $2 or $3. So I think that in a way, I just add that so that people can like maybe discount my view or whatever a little bit there, because I've actually had the same reservation about it for years, and it's just gone up and up. So
yeah.
But the thing is, you have to view it as an infrastructure play. Yeah, if Transurban builds a new road, they have to spend the money first and then collect the toll. Yeah? These guys are the same. They have to build the data center first and then collect the customers. Yeah, so you can't see it as a Bravura or a different. It's actually not. In my view, it's not a technology company, although it's in the technology index on the ASX.
I mean, we'll add. So this thing's like 5 billion market cap, so it's like pretty big already. I guess a lot of the success will hinge on whether that, for Australia anyway, that size is a scale advantage or not. Because if it's not, then I think it actually may not turn out to be so well. But if that size is a scale advantage, then well, maybe it's actually managed to eke out a competitive advantage in the space, and that's a positive.
So you're not buying it though?
No, I'm not personally buying it. I think that there are bigger US, like I own. Yeah, I won't get into it, but there are other options that are sort of in the space that I prefer. Like I have occasionally owned Megaport. I don't at the moment, but that's something I'm a little more interested in.
That's the intermediary.
Yeah. So anyway.
Okay, all right, guys. We did get a company into the portfolio today. MVP. Sean, it's a buy from Rudi. It's a buy from Claude. He thinks it's the most exciting company we've discussed today. And think about the green whistle. Again, it's to this global expansion story, which Rudi says, you might have to wait a while, but if they can execute it, it's probably worth being in it. Now, I will also say I'll do that at the end. Global health, this is an avoid at all costs for Rudi. This is a sell, like as soon as it comes out of a trading halt. If you can find a buyer for Claude, there's no reason to go near this company in either of their views. The next one on the list, EBOS Group. It's a buy for Claude. He says it's a good quality, sleepy stock. Rudi says that it could be the backbone of your portfolio. It's solid, it's dependable. However, he would buy it at a cheaper price, so it's not going into the portfolio. Bravura Solutions for Raj, it's a buy. For Rudi, for Claude, it is an avoid. It's potentially a buy under $3, but he thinks that some of the potential M&A excitement around the company has already been built into the price. So Bravura Solutions is actually being taken out of the portfolio.
I feel bad now.
Oh, well, this is why I don't tell you prior, because it'll impact your decisions. NextDC, NXT, is the last one on the list for Robert. And it is a buy, and it's on the growth profile story. For Rudi, think of it as an infrastructure stock. Claude doesn't disagree. However, it's a no from him. He's got preferences in that space, and they're not here in Australia. Now, these guys did change the portfolio today as well. I forgot to mention that Home Consortium is also out of the portfolio because of their assessment of the company. That's not upsetting you.
I don't feel so bad about that. I think Bravura probably has more upside, so I feel a little bit guilty.
No, I shouldn't have, I don't want to ruin your afternoon or anything. Listen, it's been great to have you on board, Rudi and Claude, as always. Thank you, Rich Life and FNArena, and thank you for watching. If you'd like us to cover a company, email us at thecall@ausbiz.com.au, and you can put it to a specific guest that you know we'll have in the next couple of weeks. That's fine. If you'd like to see that portfolio, head to ausbiz.co/portfolio. Stay with us. After this very short break, we will be talking crypto. And Ian Lowe, CEO of Daxi, is going to take us through the latest market movements ahead of the weekend trade. That's from 1 p.m. right here on Ausbiz.